Welcome back after the break in our Expert Speak segment. Now I'm joined by Aditya Gupta, former Executive Director of LIC. Aditya ji, welcome to Insurance Mantra. It's a pleasure to have you with us today.
Sir, just want to you and to ET now.
Okay, sir. Sir, just want to get your view because you were part of insurance industry. Still, you are part of insurance industry, I assume, for more than 3 decades. And now we have seen a new reform, Sabka Bima Sabki Suraksha. So, for consumers, for policyholders, what actually is there in this Sabka Bima Sabki Suraksha?
So, Anurag ji, aapne just now you said Sabka Bima Sabki Suraksha. The center point of this entire amendment bill is the customer. Okay, everything which has come into the bill, the focus is the customer. So, for example, they say that the regulator can now look to the commission portion, charges. So, thereby, it is with the purpose to make insurance more affordable. They have tweaked the investment norms. So, now they can also, insurance companies can also invest in unlisted companies. So, thereby, it is giving a leverage to the insurance companies to earn more. So I am sure where the cost is controlled, that makes more affordable. Where the returns are set to can get higher, again it is said to be more affordable. So one is insurance will be more affordable in days to come.
Okay.
And second is the setting up.
So do you believe that costs need to be rationalized and distribution cost, commissions need to be rationalized? That's your viewpoint?
I will not say to be rationalized, but I will certainly feel that for different class of products, there can be differential rates also. Okay. So like selling a 2 crore term insurance is very difficult.
Okay.
So there you can pay him a little more, but maybe selling a 2 crore annuity may not require the similar kind of a commission structure. So in days to come, to make things more attractive, I think IRDA has been given this power only to look at it from this perspective. That is my understanding.
So that will be beneficial for consumers.
Consumer. The entire focus is consumer only.
Okay, sir. Before that bill, we have seen in September 2025 the GST rationalization on insurance policy. So, according to you, how much boost that has also given to life insurance industry?
Anurag, this was a mental block before the person. So he says, I will have to pay 10,000 rupees as premium plus some GST. So, he was feeling that this is my basic need. Why it is basic need is tax. Now, government has taken a very bold step in not only taking this financial hit, if I may say so, but also giving the consumer to have this good feeling that we are not taxing your basic need. So one is it has become more affordable if the taxes come down. People should now take it forward, lap it and increase their protection gap. I mean, India, if you know, we are having 82% protection gap. So if somebody needs a protection of 1 lakh, he is only insured for 18,000 rupees. He needs 82,000 more. So government has pitched in for the consumers to buy more insurance in days to come by this effort.
So boost will be there more and more.
I am sure definitely it should be.
Sir, there's a normal saying that one size does not fit all. In insurance also we have seen that one product is not for everyone. So how will you differentiate different products for liability product, for income product, for life goal product, for if somebody has to choose an insurance plan?
See, first of all, you have to do your own risk profiling. So, for example, there is a boy who has a house of his own. Father has given him a good house. He does not need to build a house. There is another boy earning similar, but he doesn't have a house. So, their risk profiles are different. He intends to buy a house. He does not intend to buy it. So, he'll take a housing loan. Okay. There is a same person, the wife is earning, and in another case, the wife is not earning. So, you have to individually list your risk profiles today's and in future, what you want to do. Once you have this risk profiling done according to your goals, you can choose different products. So, in the starting of the career, you must have a good term insurance because your incomes are low and your requirement of a high term insurance is high. As your income grows, you can build up an insurance portfolio also for different need. And the beauty of this insurance portfolio is that, let us say, let us say I'm 29, I have a boy or girl of 5 years of age, and at 20 I want a particular amount to be given to him at 20.
For marriage or education.
Whatever you can say, at 20. No other instrument will guarantee that amount unless and until you contribute regularly. But in this case, if you contribute, that amount will be there. Suppose you are not there, you are not able to contribute, still that amount is available to you at that moment of time for the boy or the girl. So that is the beauty of this insurance plan. So one should profile himself as per the needs, liabilities, and take the products in future.
So at the young age only, you can decide as per your earning only, I should go for term plan, ULIP, annuity, or some money back or endowment plan.
So I would say start with term, go on adding savings and ULIPs for capital appreciation. When your liabilities are taken care of, then start building a pension fund for yourself. And life insurance companies offer all the three. There are child plans also. One of the major things which I would like to inform all the viewers is that in the child plans, there is a facility called a premium waiver benefit. So let us say you take a policy for your kids and something happens to you. What will happen to the policy? Policy will close. But in this case, if you take a premium waiver benefit, and if something happens to you or me, Anuragji, then future premiums are waived. So let us say on a 20-year policy, if the earning member is not there after 5 years, for 15 years he doesn't have to pay any premium. Okay. Policy continues, and after 20 years you will get the same amount which you promised to have it there. So that is the beauty of the insurance plans.
Okay. So now the Gen Z, the new generation, Gen Z generation is comparing insurance with mutual fund, and they are saying that mutual funds has more benefits and just go for mutual fund and term insurance, and rest all these insurance policies of life insurance, endowment, money back, annuity plans are not required. If you want to take a life insurance, just go for term insurance, and rest everything can be managed by mutual fund. So do you agree with these this set of mindset now which most of new generation is having?
You put it very rightly, Anuragji. This generation is actually getting exposed to the latest information every minute. So they are much more informed than 10 years down the line. So they are able to make a better decision today. However, as I said, everybody has a different risk profile. Okay. So one should have term insurance. But see, when we look at life insurance, it is an event-based contract. Mm-hmm. If the event happens, okay, the event may be sad, returns may be high. Mm-hmm. So let's say if something happens within a year, the returns will be very high. And if something happens in the last year of the policy, returns will be low. So one should make a combination of both the insurance portfolio as well as this capital appreciation through mutual funds.
Okay, both balancing. Okay. So now, how important is nomination, updating personal details and informing family members about the policy? And about the nomination also, I want to understand from you, can we have a multiple nominations? Because for a young individual, young policyholder, can he nominate both his spouse and parents?
Regulator has now permitted insurance companies to have more than one nomination, and you can also decide the share of each nominee. So that's a very wonderful step which has been taken. Look into the single families when you have only one child earning and is supporting the family as well as the parents. So that is very, very important. And the life insurance contract, Anuragji, if you see, if the event happens, somebody else has to take away this thing. So once you take a policy, you should definitely inform your spouse or your persons in the house that this is the policy, this is the event on which this payment will be available. These are the people who are nominee into it. And if nomination changes, that nomination change is also marked on the policy bond. One should keep the policy bond safe. So I have had experiences, kids were in the foreign country. Mm-hmm. Parents expired. So when they came back, and then they searched for some documents, then they came to know that there was an insurance policy. Okay. So if you inform everybody in the family or somebody in the family, I'm sure it will be a very good decision.
Okay. And sir, at the proposal stage, what mistake one should avoid? So at the claim stage, there should be no problem.
Very, very important, Anuragji. Again, the first mistake which people do is sign the blank document. Never do that. It will take 2 minutes only. There are very simple questions in which you are writing your date of birth, you are writing your address, you are writing your father's name, you are writing your mother's name, you are writing whether you are suffering from any illness or not. That's all. Small things which you have to write, fill it yourself because this is a contract. This is like an agreement between you and the insurance company, which will come into force in the days to come. So you should fill it up, take care that everything is written there clearly, and once you receive the policy bond also, read it once at least.
Okay. So now in life insurance industry, there is a campaign going on, Sabse Pehle Life Insurance. So I want to ask you, why should insurance be the first financial priority before other investment? And what's your view about this Sabse Pehle Life Insurance campaign? It started in 2020 also, and now in a new format it got relaunched.
Sabse pehle life insurance is very, very right, very, very apt, Anurag ji, because suppose you are making annual payments, monthly payments towards some corpus building, and something happens to you. How will the regular payments come? The regular payments will stop. You will only get that much what you have deposited. But suppose you have an insurance plan and you propose to give this monthly or yearly payments. If something happens to the life assured, the amount is going to come and sit into this well or the account. And these regular payments can continue over the period of the policy or any instrument which you feel so. Let us say insurance is not there. You start an account where you are depositing everything monthly or whatever duration. And suppose this account is not having money. All this will stop. One day you will only get back what you have deposited. So sabse pehle is, the purpose is sabse pehle that first of all you build this, that whether with you or without you. Okay, there is sufficient amount available here which can manage your periodical payments into other investments.
Okay.
So you can build a pension slowly if you have money. You can build a mutual fund portfolio via SIPs if you have money. But suppose you don't have money here, all those things will be dreams then.
Okay.
So sabse pehle insurance.
Life insurance. Sabse pehle life insurance. And I would say personally, sabse pehle term insurance.
Yes.
Okay. Thank you so much, sir, for joining our Insurance Mantra. Thank you so much.
Thank you, Anurag. Thank you.
So that's a wrap on this edition of Insurance Mantra, but we'll leave you with our Did You Know Insurance Basic. Did you know you can take a loan against your life insurance policy if you have a traditional life insurance policy like endowment, money back or whole life plan? You can borrow money for education, medical needs or other financial requirement. This loans give by the insurance company, bank or NBFC, and your policy itself is used as a collateral. But remember, term insurance does not qualify because it has no saving or surrender value. A loan can be taken only after the policy acquires surrender value, usually after 2 to 3 years. The loan amount is not fixed. It is a percentage of a policy's surrender value, and this percentage can vary depending on type of policy or investment fund. In many cases, loan can go up to 85 to 90% of the surrender value. Interest rates are generally lower than regular loans, and the loan amount received is not taxable. Even after taking the loan, you must continue paying your policy premium. If loan is not repaid, the outstanding amount is adjusted from the maturity or death claim. So remember, a life insurance policy can also serve as a financial support option during emergencies. Stay informed, stay protected. That's our insurance